What have I told you since the first day you stepped into my office? There are three ways to make a living in this business: be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Another Saturday morning, so another weekly market recap. Welcome back. A bit of a strange week for me. I think, many different things from a price action standpoint kind of remained or stayed where they were, let's say, as for last Friday's close. But at the same time, although, the market overall didn't really move a lot compared to, the previous week or 2 weeks ago, it's starting to look like nothing is really changing a lot from a price action standpoint, but underneath the hood or beneath the surface, a few things are setting up for potentially something bigger coming up over the coming weeks. So I'm getting that strange vibe where, the table is set up for something to happen. So I'll try to give my best to put that in a coherent and understandable type of a logic and concept. But let's start out with what happened from economic calendar standpoint. And of course, the beginning of the week, we got a few data as for the housing market, such as housing permits or new buildings and all the rest, but I'm not really in that stuff, so I'm just going to skip it and jump straight out to Thursday and usual jobless claims. Again, as we were saying, it was looking like a local bottom and potentially a bounce in the reads. We keep on looking at the jobless claims as for the 4 week average, and again, same type of read or behavior. And again, the most important thing we were always looking at is the continuing jobless claims, which came back up to the all-time highs, or at least, over the last 3 years at the very least. So again, the labor market is still not that rosy for me. And then we got the Philly Fed Manufacturing Index, which still in this range. Has been like that for basically at this point a year, right? We are still at the last September levels. Like, we went massively up on the back of the elections and then massively down with, all the tariffs and the kind of bearishness in the market overall. And then we came back right in the middle. So, I mean, how do you want to take this? I guess it's up to you. To me, it's not really a nothing burger. It's just a testimony of the huge swings, both in macroeconomic data point reads and also sentiment as for the future of the U.S. economy. Now, for now, at the very least, uh, GDP now it's giving us 2.3% read updated to August the 19th. So not a lot, not a big of a change compared to the previous read, which was 2.5. And the usual suspects, PCE as measured by true inflation, still hovering around 2.7%. And inflation as for the headline CPI, it ticked up a little bit, 2.10, let's call it. Still on target, more or less, but nonetheless, still moving up in this range, and we are now about to test the upper side of the range. I've seen that, that's ironic. Powell was talking, and he kind of sent out the message that instead of using the usual 2% target, they could kind of switch to a new type of measure or assessment or metrics, or call it whatever you like, by which we are not looking at a target per se, but we are looking at some sort of a range, some sort of a long-term average of inflation. Therefore, if let's say after '08 we have been criticized because for a long time, despite our policies, inflation was below target. When you average the entire data set down over decades, maybe in his view, it would be acceptable now if inflation stays a little bit above target for a period of time, since it's been below target in the previous decade. Does it make sense to you? I don't know. To me, not really. I mean, the 2% target alone, it didn't make sense for me. So these kind of a switch, it looks like some sort of a gimmick to say, well, it looks like we can't really hit that target and staying there for a reasonable amount of time, which would convince people that we know what we're doing. So let's change the rules a little bit, right? Just to make sure that people still maintain confidence in what we're doing. And it's what central banks do overall. Now the break evens again, they are still in this range, but this week or in recent days at the very least, they ticked up a little bit. Nothing conclusive yet. I'm still, convinced that we are gonna see lower inflation in the future. It can stay in a range. I wouldn't be surprised even if we have some sort of a quote unquote spike to the upside in inflation. Let's say I wouldn't be surprised if it gets back above, I don't know, 2.8, 2.9 for a period of time, right? Because I don't think it could be sustainable, right? So actually, I think that would be the final nail in the coffin for the consumers. But we might talk about it a little bit more later on. As for the credit spreads, they came down. Now it looks like this week they kind of ticked up just a tiny bit, but overall, if you look at a long enough period of time, they're still at the lows, so not really concerning. Well, I guess after these tiny parentheses of the economic calendar, I guess the elephant in the room for the week and what everyone was waiting for, it was just the Jackson Hole speech that Powell would have given out. So you can go on the Fed website and looking at and read the entire speech, or at least, I guess, or should be the summary maybe, or the recap of the entire speech. Oh, well, it says speech, so maybe it's the entire speech. But, don't have time for that. So in general, right, let's say that at the end of it, it was a kind of what the market was expecting, which was, Jay Powell opening the door for, a rate cut in September. And, it's nothing surprising, to be fair. Like we've been talking about it for maybe more than a month now. But the data were starting to suggest that it was time for policy to again to adjust. Please notice the deja vu there in the wording and the language. This is exactly the same thing that he said last year, 11 months ago. And I remember because I used the terms or the phrase for a thumbnail of a video that I recorded back then. So it's the same type of thing. We have been saying all along that we were data dependent. And so based on the data, although in my own opinion, just my opinion, a bit, a bit too late, the data would have suggested, at least to me, that a 25 basis point cut would have been advisable even in July. But, anyway. So now we are adjusting so that basically means in his own language that he's signaling that they are ready to cut. Not only that, but we started to see dissent even inside the FOMC members. So to me, at the end of it, it looks like he knew that eventually he should have had cut. Probably he didn't want to do it so early just because he didn't want to give out the impression he was caving into what the president was demanding so harshly from him. So he was trying to defend, maybe in the public's eyes, the Fed independence. And he was just waiting for the data to be so quote unquote bad that at that point he got the cover because now he can say, well, we are not cutting because the president or the White House is demanding that. We are cutting because we are looking at the data. And as we have been saying for 2-3 years now, we have always been data dependent, right? So that's the entire read I would give into it. And even again, using his own words that he used time and time again at all the press conferences, right? The balance of risk is now changed. So now he's not so worried anymore about inflation, but is looking on the other side and is looking at the labor market, which, hello, Jay Powell, yeah, it is deteriorating. It didn't start it now, right? So again, it's just the usual play of central banks, in my view, at the very least. With all due respect to Powell, I know it is a very difficult situation. It is a very difficult chair to sit in. So I might be a critic of central bankers in general, but I don't know. Sometimes, in the case of Jay Powell, especially now with the situation he's facing, uh, technically, professionally, most importantly, politically, I I kind of feel a little bit of a sympathy to the man in recent weeks and months, but that's just me. Um, so let's move on to the charts because I don't think there is a hell of a lot more to discuss about what Jay Powell said. It was wildly telegraphed by his minions going around and releasing statements throughout the week ahead of the uh, Jackson Hole Symposium, and that's the Fed MO these days. So moving into the charts, what we see is again, as I was saying, and the DXY in this case, it is just a perfect example. Coincidentally, it's the first chart we are going to look at, but a week where nothing really changed, right? We kind of came up to the upside Monday, Tuesday, and all the rest. And then, of course, with the speech and with this, green light for rate cut, the DXY just came back down and gave away all the gains of the week. Why is that? I think we have already talked about it. Mainly, I guess it could be in the short term, pricing in interest rates differential to narrow down, right? Because if the Fed finally starts to cut, the convenience in being, too much exposed to the dollar relative to the euro, it could change a little bit. So maybe people are transitioning and pulling money out of the US dollar denomination and getting them back into other currencies denomination. And since we know the weighting of the index, it's vastly out of balance against the euro. What we've seen is the euro, for sure, massively bouncing off of the news. Now, does anything really change overall? Well, I mean, not really to me. Even if you check the others, right? Look at this week, right? Even the British pound down all week and then up. Uh, the Japanese yen was just keep on consolidating and eventually came back up. So it's kind of a little bit of the same through across the board in my view. So nothing really definitive for now. As for currencies, I wouldn't put a lot of weight on what went on this week. Sure, I mean, in the very short term, it's still just ranging behavior. As for the long term, I really don't know. And I have I have a few doubts right now. Uh, it's more of a gut feeling, to be fair, and I know it's not the best the best advisor, right? Whether you are trading or investing, you're not supposed to do it out of gut feeling, but I'm just, it's just like a hitch, right? It's just something which is creeping in my brain, but I'm gonna tell you about it a bit more. So short term, still kind of neutral on this entire situation. Need a bit more data to be a bit more sure that yeah, the DXY will keep on falling, and foreign currencies will keep on rising. I don't have them for now, so for now I'm just saying neutral up until I'm told otherwise. Kind of the same with other currencies, like we've seen that, for instance, the ruble still doing the same thing. And again, it's like a broken record. Brazilian real still the stronger, Indian rupee, the weaker, Chinese yuan, not really going anywhere over the last, what, 2 months at this point, almost three. We are approaching the end of August, so yeah. So not a lot when it comes down to currencies. Let's move on to oil, right? Let's try to make this quick. Oil, rebounded a bit, right? We were looking at these internal base, considering the entire fractal base in here, right? Yeah, we tested a bit deeper on Monday, and then, immediately we started to rally off of it. Is it a major change in behavior? In my view, not really. I mean, I would be open to the possibility of an extended bounce in here, but from here again to say that I would switch to be massively bullish oil, that's a very huge leap, and I'm not ready for it yet, fundamentally, especially, not only technically, right? So, again, just I think I remember I was kind of neutral, if not short or bearish biased over the medium term, but neutral on the short term. So again, it looks like oil just confirmed that type of a feeling or bias, and yeah, we'll see how it goes. Uh, I'm feeling like this is might just be like a bit of what we told last week. So look, levels. Let's try to zoom in a little bit and see what it could be next week. I mean, I don't see any reason why you couldn't get back a bit higher than these, maybe 60, 64, right? And from there, I think then you would start to establish, can we break through this area again and getting onto the other side for a much deeper test into this inefficient leg? Um, I mean, again, a test in this area, totally possible. Breaking through right away, I wouldn't bet the farm on it, at least for next week. But again, we'll see. And I guess really the only relevant area I would look at for now. Then of course, the current lows for potentially trend continuation to the downside. But other than that, not a strong opinion on oil. If not, wait to see if these and that. Right. Let's have a look at gold. So gold came down as we've seen, but this week it rebounded. A bit frustrating. It wasn't the only frustrating thing which happened to me this week. I had a very good long on the 10-year bond, or the 10-year note futures, and I was shaken out just before he shooted higher at the Jackson Hole Symposium time. But that's another topic for another time, I guess. A little bit of frustration on gold because if you remember, I was talking about, yeah, the market could come down a bit more. Yeah, maybe. Would these lows be targeted in that eventuality? Possibly, but the first area of attention for me would be this point of release right here at the first area where to expect reaction. And quite honestly, I had a limit order there, but yeah, uh, didn't didn't fill because of course we came like 10 bucks shy of it, and we just bounced. So, well, I mean, it's not it's not the end of the world, but yeah, I would have liked to add back a bit of my gold position. Who knows? Time will tell. Maybe it will come out that it was for the best, right? Because there is this, and again, I'm kind of spoiling, no, spoilering, right? What we are about to discuss as for other risk on assets down the road, but it's just to me like gold all-time highs more or less, the S&P all-time highs, the DXY so beaten up, the VIX so contracted. It's starting to look to me like that kind of environment where everything could remain intact, right? And keep on going to the upside, slow grind, and all the rest. But from a risk adjusted type of perspective, this is looking like that situation where if things would go south all of a sudden, not only I think they would go south quite kind of sharply, but since everything is basically at all-time highs, it could come down all at once altogether. Now again, getting back to the previous videos, I'm not talking 2008 type of scenario, not talking dot-com bust or all the rest, but just a relevant pullback, right? because we have been thought for the longest time that gold is the safe haven asset. It's the asset where you go when you're looking for safety. Yeah, right. But if over the last 3 4 years it's basically moved the same as risk on assets like the S&P or equities in general over a long period of time, if you check the returns, just making a point, despite the intra-week, intra-month fluctuations and volatilities, right? Just check the returns. January 2021 up to year to date 2025. They are very similar. So in the macro world, if you don't let your day trading bias getting in the way, but in the macro world, if two assets on the same time span gives you the same amount of return, right? Percentage wise, I guess there is maybe probably a 5 6% difference, but it clearly shows you that they are moving together and they are moving in the same direction, and it really doesn't make a lot of difference whether you are in one or in the other, if not from a risk profile standpoint. And I already hinted at that in the past. Um, I like gold because I was expecting it to perform as good, if not better, compared to stocks. And overall, I was expecting the volatility, especially to the downside, to be a lot lesser when it comes down to compare gold relative to equities. So they both went higher over the last 3 4 years. But if you check the downturns, of course, gold had a lot less more volatility to the downside, which is why it was my pick. Now you can call it luck, right? But again, if you would have thought, right, these assets, the equity market and gold would have been negatively correlated, you would have expected, like, if the S&P is so much higher compared to 4 years ago, well, you would have expected gold on a macro scale to at least stay flat. Didn't happen. So again, you can keep on looking at the daily time frame and seeing that, oh, but this is going up, this is going down. Yeah, sure. If you're looking at it from an investing standpoint with a little bit of a long-term horizon, what the market did is what the market did. So you can argue all you want. At the end of the day, the charts are just going up together and basically showing you kind of the same returns. So, you know, short-term fluctuations, news, yeah, whatever you want. They're both going higher, and one of those, it's also offering you a very, you know, well, yeah, I would say a pretty evident lower volatility risk and potential drawdown risk type of a profile, right? So coming into next week, I would expect gold to maybe testing a bit higher, right? Getting back into this pocket. Another what? Another 20. What was that? 417. Yeah, maybe another 20, $30 higher, and then we'll see what happens when we get back into this pocket right here, because we got a point of release coming off of a swing failure pattern in this case. So maybe we react a little bit negatively when we test it, and after that, depending how we get into it, right? Because if we get into it sharply, then I would expect a much pronounced reaction. But let's say Monday opens up, we pull back a bit, and then we keep on grinding to the upside. So we get into it kind of orderly and very efficiently. At that point, yeah, maybe we stall a little bit, but we don't have that type of a sharp reaction. So we'll see. Overall, my thesis on gold. I'm still kind of bullish on it. I think again the only risk I'm seeing is that it moved so closely compared to other risk on assets that I kind of have that feeling that again, if people need all at once to the risk and everything is up so much, does it really matter what you sell, right? You can liquidate what you want because yeah, I mean everything performed particularly well. Now the thing is, after the eventual or potential initial shock to the downside, if things get really bad, I think gold would catch a bit, probably equities wouldn't. So this is why, again, I prefer to stay in gold. Now, let's have a look at Bitcoin. Bitcoin came down, opening up the week on Monday, a pretty sharp drop. But then again, it found a bit of footing right at previous support. It got back in this range. Now, a bit of a disclaimer. The more we go ahead, the more I don't know how much relevant this previous range would stay, because again, ranges are made up to be broken at a point. So could also be that, especially looking at the behavior right now, you would need to redraw it and to make it a bit higher, because now you could look at these support right here as a low side of a new dealing range, which, it expanded a little bit, right? And then that would be your high side of the range. So I guess, in time, I might just delete that, or at least, saying that it's not relevant anymore as it was before. We'll see next week, but for now, I'm just keeping it on to have a little bit of a reference point. All right. It still fits the thesis, as discussed last week, that if we can't have enough juice or power or speed to reach up into that escape velocity, again, what happens? We get back and we gravitate back toward the equilibrium point of the range. All right. I'm not massively bearish Bitcoin. Like, I still think, could it test a bit lower? Yeah, absolutely. But I'm not in the camp that we are gonna see it getting back below, let's say, 100K, right? The level to me, which is the most important for now to maintain this type of a structure to the upside, it's still, or it would be still, at and around 109K, more or less. Or, if you want to have a bit more of an area instead of a defined level, just look at the gray rectangle overall, right? So again, nothing really changed to me in Bitcoin. I've seen we got a little bit of a changing behavior when it comes down to the relative strength. I got a friend which is very interested in Ethereum. So in the chat, especially this week, we have been following what Ethereum was doing. Ethereum actually made new all-time highs, I guess. Well, actually, we could actually check, right? So let's see. Is it new all-time highs? I guess it should be. Let's see. At least on this exchange, which is Coinbase. Uh, yeah, ever so slightly, but it was new all-time highs for Ethereum, I think. Yeah. Yeah. So again, it's performing particularly well while Bitcoin is stalling a little bit here. I think the drivers are mainly the Genius Act, in my view. Like the amount of demand that it could create for Ethereum, it would be massive if it really goes through, right? So if you didn't check what's the quote unquote plan right there, uh, I mean, I think at the end of it, it doesn't really have a lot to do as for cryptocurrencies in general. It's more of another way to find or to create bidders for the US treasuries. But, it could impact positively Ethereum, since a lot of those stable coins are actually running on Ethereum. I guess more than half of them. Uh, and more than 40% of the transactions when it comes down to stablecoin is actually happening on the Ethereum network. So yeah, fundamentally that would be a good driver for Ethereum to go up. I'm not a huge follower when it comes down to, stablecoins, smart contracts, DeFi and whatnot. So that is as far as I would go in assessing what could be the potential driver for this huge run up in Ethereum. Just one thing, oftentimes you see stuff going up parabolically on the top of the rumors, and then at that point you have that give out period or give back period, so the usual pullback. So I would say it's always prudent to the risk or to take some profits, like to take off some chips off the table when you're winning massively, so that you don't regret it later on, right? But maybe that's just me. I do like to take profits when they are available, when the markets make them available in such a unique and very prominent way. It could be different for you. I'm not here to judge. I'm not here to be your dad. I'm not here to tell you what to do. It's just, just some thought, I guess. Let's have a look at yields, which of course came down, not massively on the long end, a bit more evident in the mid end of the curve. And of course, the short end it just plummeted. They were kind of ranging in the beginning of the week, which is not unusual. I mean, we are getting into a Friday where you're going to have Powell setting up a monetary policy or signaling what monetary policy will be. So it was expected to see yields kind of going anywhere and then, moving with conviction one way or the other when the so-called news would have been released. Still, again, my bias on yields is always the same, never changed. It's a very long-term bias, so short-term fluctuations, they don't really impact my view. So yeah, I don't have anything for now which would suggest me to change my stance, which again, it's about lower rates into the future. It's a matter of months, so I'm repeating it again. I'm not expecting to see it next week or next month. I'm willing to bet this thing could drag very well in 2026. Why not? But yeah, it's just that I don't see a driver for higher inflation and therefore high yields into the future. And even if you listen to what Powell said, finally he transitioned from tariffs inflation could be a problem, right, to yeah, tariffs inflation, it could be a thing, but maybe it's just one off. And again, it's kind of funny for me to see why did it take him so long to get to that conclusion. But yeah, maybe that's just me. And sure, if I'm here and he is where he is, I guess he knows a hell of a lot more that I don't know. So again, these are just my opinions, right? Conversely, so the underlying treasuries, they moved to the upside, of course. Again, a bit of a frustration. That was a very good buy right into here. Not really into here at this level because this is the continuum future. I was looking at this. Was it the September expiration? I guess. Yeah. So yeah, that was a good level in this area right here. Being shaken out and then it went. So it can happen, right? So that was a trade I've been discussing all the week, and my conclusion in the end was, look, yeah, it's a bummer. Yeah, it's annoying a little bit, especially because the moment I was taken out, I was already. It is totally possible I've just been shaken out, and this thing is gonna go. But probably again, it gets back down to risk. I had a considerable risk on that trade, so it went up. I didn't want to see it coming back on me, so I just closed it for a little bit of a profit, not a lot. I guess it was maybe 8-10 ticks if you are familiar with T-Notes futures, so not a lot really. And the thing is, at the end of it, this is just how the market works, right? You can't be perfect. The market will always try new ways to screw you up and to fuck you up. But the positive or the bright side is, look, up until the point you can generate winning ideas, right? Sure, there should be the time, or there will be the time where the idea is right, but you don't have the guts to put on risk. Or like in this case, there will come the time where you have the right idea, maybe the wrong timing, right? But up until the point you can at least identify good setups, take it under a positive light, because that's what you need in order to generate profits over time, right? The outcome of one single trade doesn't define your P&L over a long period of time, like months or of years. It's just a little bit of a hitch in the moment, but you just need to walk to walk on, keep your chin up, and it's quite a little bit of a it's a little bit of a nerve wracker, I guess, that because it happened on what was that? Yeah, on Friday. So you kind of have the entire weekend to keep on thinking of it. But then, comes next Monday, it's a new game, it's a new setup, it's a new word in financial markets every single week. So just don't hang up on let the past in the past. All right. Now, again, a little bit of a pause before looking at stocks, and then we'll wrap up the video. And again, I think it probably is gonna be a bit long on the longer side again, right? So getting into stocks, first of all, let's look at that. So this week, as we can see, right, you see a lot of red, which is mostly concentrated in the big caps, right? So the rest of the index, more or less, you see a decent amount of green, right? But of course, you see, for instance, Amazon, Meta, Microsoft, Apple. So a lot of big caps, and especially in the tech sector, which were kind of negative for the week. This is important because we have been talking about this potential rotation in play. Um, and it looks like finally we are probably in the midst of it, I would say. Now, do you remember we were talking about high beta, low beta, right? Sectors which were particularly overextended, overbought, and sector which were a bit out of favor, right? So, finally we got it. Now, importantly, I think we should notice, for instance, that when it comes down to this week, it was also last week, if you remember, but we got earnings, right? The earnings report for Walmart, for instance, I mean, they kind of delivered on revenues, but nonetheless, they missed out on, overall earnings per share by, an 8%. So is it important? I like is it a massive problem for the index in general or the stock of Walmart if you're trading it? I guess overall it's kind of like a little bit of a warning sign. So basically they are signaling that they are not able to keep on maintaining the earnings. And remember, Walmart, it's basically one of, if not the major retailer in the US. So what does it tell you about the conditions of the average consumer, right? And not only that, but if you check, we have been looking at what McDonald's, I mean, we didn't mention, but I was following that. But, if you remember what McDonald's came up with, they said that no matter their efforts to cut down prices, making their products more available to the consumers, they were looking at slowdown in traffic. They were noticing that people were starting to skip breakfast. And this is nothing new. Do you remember after the pandemic, they came up with that $5 lunch and all the rest? And still, no matter their efforts to bring consumers in, bring traffic in, they're noticing a weakening of, consumer demand, which is again on top of a labor market when you check the macroeconomics data, which is showing cracks, weaknesses, and deteriorating conditions. So again, this is not surprising at the end of it. So overall, what we have been looking at least this week, over the last 5 days, you see where is the major part of the weakness? Look, technology, and of course, communication service. Now, consumer discretionary to me is a little bit of an anomaly. I would have expected to see it coming down a bit too, but again, can't always have it as you want it. But it was just strange to see it being uh, again higher compared to my expectations. Now, I was expecting a bit of a rebound. If you check back, I guess it was 2 3 weeks ago, we build up a case for healthcare, right? Although with the caveat of, regulatory risks and all the rest. But we at least we identified that there were a few sectors, like healthcare was one of the main for me, and then of course energy, that were a bit out of favor, right? Against a few sectors which were massively overextended. Uh, I think, yeah, probably 2 weeks ago. So again, when you see those situations, even inside the same overall broad index, but if you check the different sectors, you can, kind of anticipate these rotations coming in, especially again when the overall market is particularly overextended, and we have been looking at a situation where we were starting to build up divergences on the indicators. Although the market was still going up, we have been checking, I think, the flows, the money flows, which were slowing down, again, creating a negative correlation. There. So, sorry, not a negative correlation, a negative divergence, right? So again, the market was showing cracks, and the title of the previous week video was actually risks. So again, now, um, is it a massive problem for now for the market in general? This is where again I would say that, kind of like last week, the chart it's not utterly ugly or bearish, right? The problem for me it's still the underlying. Now, last week we've been focusing a bit more on the macroeconomic factors. This week, let's just have a look after, again, establishing that we are still going higher. We didn't break structure on, not on the QQQ or not on the SPY out, just, a little bit of an aside. I switched back to ETFs just for the sake of it, right? There is no particular reason. It was just to kind of get back to the previous type of habits, right? But again, structurally, we don't see a lot which would suggest immediate downside risk, all right? So again, always be mindful of it. But if we focus on a bit more of a broad view, what we see now is, look, the Dow Jones was up at the end of it, and especially if you check the reaction at what was released on Friday, you see the Russell came up, the Dow came up. Now, why is this? Well, look, especially when you think about the Russell, these are small caps, right? So they are much more interest rate sensitive compared to big caps or mega caps or big tech, right? They are interest rates sensitive because they have a higher level of debt, right? They need more debt in order to finance their operation. When you think about something like Nvidia, Microsoft, Meta, yeah, I mean, not only they have an easier access to debt, and probably they can kind of scoop out better uh, financing conditions, right? But they can also finance themselves by the revenues and the profits that they generate. All right. While instead, small caps, they don't have first that easy access to credit and those probably easier credit conditions, and they don't have the same amount of revenues, so the same level of cash flows or cash balance in order to finance themselves. Which is why when they see, or at least when the markets see the possibility of the Fed dropping rates, the knee-jerk reaction is, well, that must be good for the small caps, all right? After we assess that, let's have a look at these, because this is one of the things which is kind of catching my eyes the most. If you remember, in the past, I've always said, look, I like to see the broad market like rallying, and in order to kind of have the confirmation that I should be massively bullish, I would like to see the Nasdaq leading the way. It doesn't really matter if it, like in this case, it's Nasdaq futures or if it is the ETF, the QQQs, or the index. But whichever case, I would like to see the Nasdaq leading the way. Why is that? Well, look, first of all, because in recent times we have seen that at the end of the day, the main driver for prices to go up has been growth, right? So growth versus value. I think growth played a much prominent role in lifting the overall indices higher, right? So Not only that, but also for the weighting inside the index. What do I mean by it is, look, if you see this type of divergence in this case, now it's not really confirmed, first of all, right? Which is why I was saying in the beginning, it's more, for now at the very least, it's more of gut feeling rather than actual data and price charts and all the rest. But what I'm looking at is, can we really build up divergence as, the S&P can make new highs next week, right? And the Nasdaq can't follow through, right? Can't keep up the pace. Now, why would it be, in my view, not such a good sign? Well, because again, the Nasdaq, it's made up of a lot of big caps, right? The Nvidia, the Microsoft, the Meta. So if you build up that divergence, even if the S&P makes new highs, if the Nasdaq doesn't follow through, I would expect the S&P to be, I would see it as a particularly hard scenario for it to keep up the momentum to the upside if the rest are of, the usually weighted stocks in the index are not following along. And therefore the Nasdaq, it's not really catching up. All right. So how do you know that these kind of a reaction or knee-jerk reaction we had on Friday is just quote unquote smoke and mirrors? Well, first of all, I would say, look, pay close attention. It could be next week, right? If you see these Friday's candle right here being completely negated, as completely obliterated, and price just drove back toward the origin of the move, that is already a telltale sign that all it was potentially, right, is, look, the market was going down. We were coming in a very serious announcement, again, Jackson Hole, right? So a lot of different participants maybe were just playing and building up edges, so shorting to cover up their positions. We got the news, so all those edges have been closed down and liquidated with this move, so all of them are neutralized now. If you want to be bullish, what you need to be seeing now is the market to really keep on going higher. And again, with the Nasdaq catching up. If you see this entire move negated, that's where I would turn kind of bearish in the short term. All right. And that would go hand in hand with what we've been discussed over the last month and a half as for the macroeconomic picture, right? So that's kind of the tricky part I'm looking at right now. Macro data, they weren't already rosy. Now we got this kind of a potential divergence building up. And again, I tend to believe that over time, the Russell and the Dow, the overperformance of these two relative to these other two on the left, it doesn't last so much. So to me, it's just the risk for me is just to see a quick reversion of the entire dynamic we have been witnessing on Friday. Will it happen next week? I don't know. Again, I'm just saying, and it's kind of like a repeat of what I said last week. The market, from a technical standpoint, structurally, even if you check the moving averages, right, it's not really telling you we should be massively bearish. Sure, the risk is there because we are building up divergences, all right, but structurally, we are still on the go for a bit more of upside. The problem, again, it's in the underlying first, in the dynamics underneath the hood, and now there is the possibility we build up something which could have a technical relevance, right? Just wait and see what happens here, right? Right? Now, on top of it, again, if you put the entire thing inside the narrative of rate cuts, right? Again, we get back to the same discussion. Are rate cuts a positive or a negative for the market? I think overall they're pretty much inconsequential. And what do I mean by it? It's that I don't think, again, that monetary policy or what the Fed is doing or not doing, rate cuts or rate hikes, they're not really setting up the overall direction for the market or the economy, most importantly. Those are just a reflection of what the economy is already doing, and in time, the market should track what the economy is doing. So I'm not particularly worried about rates being cut or not. Actually, I could argue for the opposite side. Like last time, if you remember, when Jay Powell cut rates, what we've seen the long end of the curve going up. He just cut 100 basis points, and the 10 and 30 years they went up by the exact same amount in the opposite direction. So I don't really think it's all about rate cuts. For now, I think it's just about what the market would expect off of rate cuts, which again, usually the initial reaction is always rate cuts are good because it means more liquidity for markets, therefore risk on assets should be appreciating, right? And it can last for a while. I'm not arguing against that. It's just that at a point, and especially again, I'm bringing up another type of topic, which for me, it's not completely out of the table yet or off the table. And picture this: rate cuts are bullish. So again, the market should rally. It might rally here for 1 week, 2 weeks, whatever you. And then all of a sudden, you start seeing other data points coming in, kind of bad. And if we get back to the economic calendar, what you see is that for the rest of the month, I think next week we're gonna have what? I think GDP maybe. No, PC. That was PC, right? We got PC. Then next month, so the beginning of September, just before ahead of the FOMC meeting, what we're gonna see is ISM manufacturing, but that's not really what I would be focused on. I will be focused a bit more on labor market data. So we got a JOLTS, September the 3rd, then again ADP, September the 4th, and then you got NFP and unemployment rate, September the 5th. But I think we also have an inflation CPI read, September the 11th. So just ahead of what will be the next, also retail sales. And then after all of that, we're going to have the Fed interest rates decision on September the 17th. So picture this: the market could go up on these signaling of rate cuts coming in less than a month. In that time span, which goes from here to then, what if you start to see those data points coming in negatively, and the market all of a sudden, the sentiment, the narrative transition from, wait a minute, that was supposed to be positive, right, for risk on assets, but the data points on a macro scale, they are keep on deteriorating. Could this be that maybe the old man it finally caved and decided to cut rates because actually he's seeing that the economy is slowing down too much, and it just wants to jump ahead of it instead of having to catch up and being behind the curve. So wait, should we really buy this market now? And I guess it snowballed from there because sentiment can change real quick, especially if price or volatility picks up, right? Not to mention, again, as I said in the past, I'm not totally ready to roll out the eventuality of a 50 basis points cut. But again, you should look at those data points that will come in over the next 3 weeks and see how they come in, all right? Especially on the labor side, so unemployment, NFP, right? Because remember, the current trend for NFP, especially when it came down to revisions, well, that's not so encouraging, all right, among other things. So just, it's always the same thing. In Powell words, the balance of risk. The market will go up, probably. Yeah, I wouldn't be surprised if the market is higher next week relative to where it closed this week. Maybe, right? Still, keeping in mind, and hopefully, if we don't see this divergence in here actually being confirmed, right? So that's the main type of a risk or potential warning sign you should look for in price action. And secondly, these entire daily candle being reversed as for the S&P, right? But other than that, if you see the market keep on going higher, but at the same time, the data points are actually getting negative by the day, at that point, again, I would reiterate, that is the time to be nimble, to be a little bit on the defensive side. So just, a crazy idea. Would that be a rally you want to sell into? Just, just to be safe. I'm not saying sell everything and go to sleep for 2 years, but, trim down the positions which are performing particularly well. Although, I don't know how many you could have, especially because the the positions which were performing and overperforming were, of course, high beta, big caps, mega caps, big techs. They already started to kind of slowing down or pulling back a bit. So maybe the time to trim down the overextended positions, it's already here or it was already here. But again, just don't forget these inner dynamics of the market. You don't sell when the market it's already tanking. Usually you want to sell a little bit ahead of it, all right? Same as you don't buy when, the market it's still tanking, right? You buy when you see a particular low being put in. It's a little bit of a different dynamic on, when you play it on the downside relative to the upside. But because at the end of the day, the goal is different, right? On the upside, you might not be hurt in anticipating the sell because you just trim the positions. And then if the market keeps on going higher, you're still profiting. On the downside, you might want to wait for a confirmation because if you buy and then the market keeps on plunging, then you're underwater. So it's a little bit of a different dynamic. Okay, so closing down, maybe I don't know. Last thing, we are still looking at a put to call ratio on the low side of the spectrum for now. So maybe that's another telltale sign that you're not too late if you want to buy protection or if you want to hedge yourself in a market which again has been looking over the last 2-3 weeks like a two-tape market, right? A bit up, a bit down, a bit up, a bit down, right? Same for the S&P, up, then down, up, then down. So at the end of it, my advice, assuming you would trust it, which by the way you shouldn't, but my take would be always the same. Manage your risk. One nice way to manage risk is to trim down positions and take profits, right? So again, after that, I don't think there is really anything left to be said. We'll be back next week and we'll see how it goes. We could see a market which really goes up parabolically on momentum, or we'll be looking at that divergence in between the Qs and the spiders playing out, and maybe we should be a bit more risk adverse again. We'll see. That's a topic for next week. As for now, I'll wish you all the best weekend ever. Have a good time, relax, chill out, and as for the market, stay vigilant, stay sharp. Be nice and be cool. Knees out.
Shit, this is really gonna affect people.
Yeah, it's going to affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. The funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well then the same people are gonna laugh till they piss their pants because we're gonna look like the biggest pussies God ever let through the door.